India can see a bit of a breather in the first half of 2023.
Nimesh, thanks a lot for that. Very interesting. So thank you for recapping what all of these different brokerages have to say in terms of what 2023 could look like. In fact, we also have a guest joining us right now. Nilesh Shetty, Portfolio Manager at Quantum Advisors, joins us on the show now to discuss the market. Nilesh, good morning and thank you very much for joining us. This is Pavitra. What do you make of what 2023 could look like? Yes, we have seen outperformance in the year gone by. What do you expect in terms of, where the market is headed over the next year?
Yeah, just the way India is positioned domestically and internationally, it's unlikely that India would have underperformance or significant underperformance relative to EMs or rest of the world. I know a lot of large investors who had significant allocation in China in EMs are very clear they will not allocate more to China given the political developments there. The only other emerging market which sort of comes in their mind to sort of put more money into right now is India. So I expect India to draw a lot more flows. So again, the way India is positioned globally relative to rest of the EMs, which are going through some of their own problems, makes a very strong case for more flows coming into India internationally. And the second is just the way the economy is positioned domestically. I mean, after almost 7 years of economic slowdown from 2013 to 2020, it looks like we hit a bottom somewhere around that COVID period, and the upcycle has started, and it will last for the next 3-4 years for sure. And in an economic upcycle where corporate earnings are rising and flows remain strong, domestic as well as international, I would be very surprised if Indian markets do not give decent returns.
Okay, so decent returns expected from Indian markets. Nilesh, good morning. There are a lot of new sectors which are emerging, right? Whether it is electric vehicles, renewable energy, defense, which has played out quite well actually in 2022. Where do you see the alpha in 2023 emerge from?
Yeah, so the way we have positioned our portfolio, we have a very large weight in financials, including banks, which have, if you plot the market from the bottom of COVID, it has actually been a big underperformer, the entire financial space. And so we think there is value there. We have a very large weight in two-wheelers because, again, most of these companies are 3-4% dividend yield, generate a large amount of cash. There has been periods of rural distress which has hurt their valuations, but given where they stand today, any kind of rural pickup will see a re-rating in these stocks. We have incrementally started adding weights in sectors which were the fancy of the market, say 2 years ago, but have been sold off because they are near-term challenges. So you have companies in the insurance space, in the broking space, in the asset management space, which were again trading at substantially high valuations, but now they've seen a significant derating as some of these sectors are going through their own internal challenges of competition and near-term growth challenges. So we think this is where opportunity lies. Investors perhaps might want to look at the sector. Also, incrementally, we've been adding weight in IT as well after the sharp correction. We think the long-term story is still intact. You might have some near-term challenges on cutting discretionary spends by global IT companies or global spends on IT. But apart from that, just where the valuations are, they make a lot more sense to allocate this sector now relative to where they were a year ago.
One follow-up, you said you're overweight on two-wheelers, but there seems to be very low conviction in terms of recovery in two-wheelers. There are new emission norms as well. Rural market has not recovered in a big way. So are you overweight only because valuations look comforting for you, or are you expecting a revival in demand?
Yeah, both. So valuations have been attractive for a while now, last almost 3-4 years. So volumes peaked out somewhere in 2019, just before the emission norm change. After that, we've had periods of COVID and rural distress, which has kept volumes very low. And of course, price hike has been substantial post the change in emission norms, which has taken a bit of while for the demand to catch up. But again, given the quality of companies in that space, very clean balance sheets, very large cash flow generation, and the relative position that they enjoy within the space that they occupy. So a large player in the executive segment and the other player slightly in the premium segment. Again, we think there is a structural story still there to play out, given the poor state of public transport. The de facto public transport for India is two-wheelers. And as sort of more job creation happens in tier 2, tier 3 towns, more number of people come into the job market, their first choice of preference to buy would be a two-wheeler. We still think volume growth will recover from where they are today.
You said that you've started buying into IT names. If you have to invest an overall amount of 100 rupees, how much have you bought at current levels? And just to get a sense of, how much is still left for you to go ahead and buy, because you are waiting better entry points.
So our weight in the IT sector probably has gone up by 3 percentage points. So we had reduced the weight by almost 4-5 percentage points at the start of the year, given where valuations are. After the correction, we've started adding an increase of it by almost 2-3 percentage points, but we'll continue to add. Again, we do not believe the long-term structural story has been hurt. I mean, Indian IT companies still have a very, very small share of the global IT outsourcing market. And that share is only going to increase. You have these near-term cyclical challenges where if the Western world goes into recession, you might see some cut in discretionary spends. So growth rates which were in the range of 12 to 15% drop down to say 8 to 12%. But it's still a very attractive growth rate for the kind of cash flow that they generate. And of course, once the cycle reverses, you again see an upcycle in growth rates. So at a certain valuation, it makes a lot more sense to us to add to them. And right now, we think it's relatively attractive in terms of where they are positioned in valuations.
Okay, got it. That is on IT. Nilesh, how do you look at the entire auto pack? And, is there any theme within that you would play, whether it's the EVs or is there any sort of segment within the autos that you would look at? Because we are still talking about demand not quite, picking up too much. We have the December sales also on the 1st. So how would you look at this space?
Yeah, I mean, Indian auto story is one of the simple sort of top-down allocations that any investor can make. I mean, where penetrations are in the four-wheeler as well as sort of commercial vehicles or two-wheeler, there is a long headway for them to grow. The question is valuations. For us, there is a lot more valuation comfort on the two-wheeler side than the four-wheeler side. The companies on the four-wheeler side remain, a lot of the good news is already factored in their valuations that they're not corrected materially, unlike the two-wheeler space. So we have had allocation in the two-wheeler space. But again, outlook for the auto sector remains very, very attractive. We are not big believers of the EV space so far. I mean, there is a long-term sort of transition which is going to happen, and a lot of new names have come in. But when we go and meet a lot of these new players, the ecosystem is just not there. A lot of them still remain assembly shops which are importing from China and selling in India. We still think the incumbents will perhaps become a larger share of that EV market whenever it develops. But I still next few years still will be the old ICE engines market which will dominate, and most of the existing players which have very strong position there, it will be difficult to dislodge them.
So what about these auto ancillary makers who are going big in the EV space, whether it's something like an Uno Minda, or even, I mean, in the OEM space, something like a Greaves Cotton? They've given great returns to shareholders in the past. What do you do with these names?
Yeah, we've actually had a very small allocation in the auto ancillary space. So there are themes which investors like to buy, but when you go on the ground and see the actual size of the market and what is the quantity of the volume that these people are doing is still so negligible compared to the size of the market. So what I think is the news flow share compared to the market share of these EVs, there is a big gap. So they dominate the news flow for some reason, but on the ground activity is still very small. Again, a lot of investors looking at news flows buying into companies, but on the ground data suggests otherwise. And you need to be careful if you're trying to buy into these companies, betting on these long-term themes.
Nilesh, thank you very much for joining in and wish you a very happy new year. Get into a short break. On the other side, we'll talk about the new kid on the block. KFin Technologies has made its debut in the Lal Street. We'll be joined by the management in just a moment.